Ignition sequence starts. 6, 5, 4, 3, 2, 1, 0. Liftoff. We have a liftoff.
Hey everybody, this is the Digital Asset Investor. I wanted to thank C3_Nick from Twitter. He put some really good things up about Nasdaq last night, I believe. And I have to go over this. This is from the Nasdaq, and it says, I think they just put out, I believe this was just a fact sheet that they put out on one of their websites for building transparency and investor protection into emerging disruptive markets. I think this is more or less a fact sheet that you can fill out your information on and get. And you go to I think it's Nasdaq.com, and you can find it maybe if you do a search. But more or less, if you fill out your information, probably they're trying to get an indication. I would imagine they're trying to gather names, people interested in cryptocurrencies for when they launch their digital asset platform. But it's important. I wanted to show you, this is the angle from which, I don't care who it is, backed, Fidelity, Nasdaq, all of them are coming from an angle, their sales pitch more or less is that we can protect you better than all these exchanges, these crypto exchanges that got this ball rolling. And I think that's kind of their theme, is we're going to protect you. We're going to be able to store it. We're legitimate. And I think that's their sales pitch. And why wouldn't it be? I mean, it's a smart way to go about this. And so they're starting to go and explain through things like this. They're starting to explain to the investors that are showing interest in digital assets how they're going to be different from what's out there right now. And you're not going to have to be worried about your assets being stolen and all that business. And so this tweet from C3Nick is one of the quotes. At Nasdaq, we're determined to build and foster transparency into emerging disruptive markets. And so that's their theme. But the other theme that I want to point out is the next thing that is said. But before I go to that, I'm going to show you Backed. See, introducing Backed. Well, the name itself, Backed, this is back. We're different than everybody else. We're backed by something. We're backed by the full faith and credit of traditional Wall Street. We're not these crazy crypto exchanges that have been that you've been having to deal with right now. We're backed, and we're bringing trust and utility to digital assets. Now that's fine with me, because they can take all the credit they want for being the go-to, the safe place, and now you can all invest and feel safe. I want everybody to feel safe, because if they feel safe, we are all going to make a pot of money. And so bring on the safety. Okay, next, this is also from C3Nick, and this is my favorite quote that he put out last night. This is from the Nasdaq. This is on the channel, the TDA network from TD Ameritrade. And at the 30-minute mark, Tony Sayas, Nasdaq head of marketplace and regulatory surveillance. For us, crypto is very much a new asset class that we are moving into. Well, let me tell you, people, this is one of those drums I keep pounding, and I will continue to pound it. New asset class is everything. It means everything for us. It means everything. And so every time you hear new asset class, and I have so many new people that are watching my channel, that every time this subject comes up, I'm going to pound the drum again, because it's one of the most important things in this whole deal, that it's important for you all to understand what this means for all of us that are investing ahead of all these guys coming in. But I wanted to first illustrate to you that Fidelity also, institutional solutions for a new asset class. They keep hitting that same beat, asset class, asset class, asset class. And that's how I knew when I heard the word asset class. And for those of you that have never heard me say it, I was a financial advisor back in the day at Morgan Stanley. I'm not a financial advisor now. I'm a digital asset investor now. But I was a financial advisor back in the day at Morgan Stanley. Well, they always taught us that there are asset classes, and what you do when you're speaking to clients is you tell them that they need to diversify and they need to use asset allocation to allocate their assets based on their risk tolerance across all the different asset classes. And I will kind of give you a snapshot of that for those of you that haven't seen it. This table right here, I just happened upon, and it's pretty interesting. And I think, it's pretty interesting. It shows you some of the asset classes across the top here. And if you can't read those, I'll read them to you. These are some asset classes: stocks, fixed income, real estate, commodities. Those are asset classes. And financial advisors, I don't care if it's institutional or if it's retail financial advisors, in the entire world, they all have the same asset allocation playbook. This chart that you're looking at shows you how the different variations of how different firms, now this could be an old chart put together, this could have been put together in 2015 for all I know, that's not relevant. What I want to show you is all of the big names, you name it, BB&T, BNY Mellon, BlackRock, Citi Private Banking, Deutsche Bank, Fidelity Investments, Goldman Sachs, JP Morgan, Merrill Lynch, they all have the same playbook. And that playbook is, when you speak to your client, we're going to allocate their assets depending on their risk tolerance and their stage of life and various other factors. We're going to allocate their assets across several asset classes. The asset classes being stocks, fixed income, real estate, commodities. And what's important for you all to know is that when you hear these guys talking about digital assets being a new asset class, what they're telling you is, the end game is, what they're telling you is that one day in the near future, all of those financial advisors, retail, institutional, and otherwise, are going to be going out with their marching orders once they all are able to make money. And that's the key. Once all of these Wall Street firms and these traditional firms have it set up and it's in place so that these financial advisors across the world have a way that they can make their, you've heard it said, make your nut on something. When they can make their money on these digital assets, it's game on. And once it's game on, you will see them, and I'll show you an example. This is a asset allocation of the super rich. Now, these three here are things that mostly only the super rich would have access to, so I don't really count those for you and I. But you'll get the point. This would be like in 14% in global equity stocks. This would be U.S. equities stocks. 7% in municipal bonds. Taxable bonds, like maybe corporate bonds, would be 10%. Cash, 7%. Direct investment, 2%. Other, 1%. And then they've got commodities. It's cut off here. But commodities looks like it's somewhere in the 4 or 5% range. Real estate, 6%. And then they've got these, which would be exclusive things for super rich people. But the important thing for you to get out of this is that is what is going to happen with digital assets. This is when the digital asset investor got into this, that was when I really truly realized, when I started, I was immediately thinking, this is a new asset class. And if it is, and I told my wife in 2013, if this is what I think it is, and one day we're able to go to wherever, E-Trade or TD Ameritrade or whatever, and transfer XRP or buy XRP, if you're able to do that, then I will have been 100% right about all of this, and everything could change. And so back to this chart for a minute. This kind of shows you the percent. This shows you the total percentage that these companies, at whatever time this was, had in stocks as their asset allocation. And then it shows you what they had in fixed income as their asset allocation. Now notice the commodities row and the real estate row. Real estate has more trillions of dollars in it than any asset class. Commodities has the least. Gold being probably the largest of the commodities has about $7.5 trillion. I've told you that before. Real estate has $200+ trillion in it. But these commodities, look, on average, there's about 1%, one or so, 0.5% to 1% of the allocation that is in commodities out of all of these digital assets, or all out of all these asset classes. But what I'm telling you today is what is about to happen is, because you have the first new asset class in over, I think it's over 300 or 400 years. Bonds being the last one that came out from the Bank of England back in 1696, I believe. Well, what you're about to see is, not only are you going to see probably 0.5%, anywhere from 0.5% to 5% go into digital assets, but a lot of that is going to be flow out of these existing, out of the existing asset classes into the new one, and that is huge. And if you just go and start looking around at how much money is all in all these asset classes, and what would happen if you just put 0.5% to 5% in digital assets, we're talking trillions and trillions and trillions of dollars, and that doesn't even bring up use case and utility, which is what XRP is all about. If there's any digital asset in the world that has utility, where money will be flowing through that asset, that digital asset, because of its usefulness, it's XRP. We're not even talking about that right now in this conversation. We're just talking about the money. And if you had any question, I showed you this asset allocation of the super rich. If you had any question about whether that's actually happening, look no further than Yale University. This is what I showed you a while back. Said to invest $400 million in Paradigm Crypto Fund. Well, this is Yale Utility adding to their batch of in their batch in asset allocation. Go ahead and write it down. That's what they're doing right there. It's already happening. And when you see this thing explode, it's going to be, when it really explodes, you're going to see retail, you're going to see, it's going to be all over the world. Every financial advisor across the world and across all of these traditional financial firms, they'll be doing it. Write it down. Final thing I wanted to tell you, I got an email from the Ledger people this morning. They're running a December 30% off sale. So if you've been putting it off, there's still time for Christmas. These guys are giving you 30% off for the next, I guess, couple of weeks. So in the description of all of my videos, there's a link that takes you straight to Ledger. And for those of you that don't know, the Ledger Nano S is a hard wallet. It gives you the ability, as an average Joe like me, to store your digital assets offline, or your keys offline, so that you are not susceptible to being hacked. Do not keep your digital assets on exchanges. I've shown you before. My family's been a victim of hack, and we learned the hard way. Trust me. And so, if you're going to store digital assets, this is the safest way to do it as of today. I'm the digital asset investor. I'm not an investment advisor. This is for informational, entertainment purposes only. Please subscribe and hit the like button, and tell your friends and family that there's a 30% discount with the Ledger people, and go in the description of all my videos and click on the link and you can go get one. Thanks for listening.